Are you looking for ways to invest your money? There are several options out there, from stocks to real estate. Which one should you choose? There are two main types of investment vehicles: equity investments and debt instruments. Equity investments include stocks, bonds, mutual funds, etc. Debt instruments include loans, mortgages, credit cards, etc. Equity investments offer higher returns, but they also come with greater risk. On the other hand, debt instruments provide lower returns, but they are less risky. The choice between these two depends on your personal financial goals. You can start investing in any type of investment vehicle right now. However, it's important to understand how each works so you know what risks you're taking. Here are some basic tips to help you make smart choices about your investments. Please like and share the video, subscribe to this channel, and click the bell icon for more updates. Number 1. Understand your risk tolerance. Before making an investment decision, determine your tolerance for risk. If you have a lot of money invested at once, you might be more willing to take on additional risks. But if you have little or no savings, you may want to consider putting off investing until you have enough saved up. Number 2. Consider your time horizon. Think about how long you plan to keep your investments. For example, if you plan to hold onto your stock portfolio for only 5 years, then you probably won't need to worry too much about diversification. But if you plan to hold your investments for longer than 10 years, you'll likely want to diversify your investments among different asset classes. This way, even if one class does poorly, you still stand a chance of doing well overall. Number 3. Choose wisely. When choosing investments, pay attention to their performance history. You can find historical data online, such as Yahoo Finance, Morningstar, and Bloomberg. These websites will give you information about past performance and show you whether your chosen investments are currently underperforming or overperforming compared to others. Number 4. Evaluate your portfolio. If you already own investments, check them periodically to see how they've performed. Are they performing better than expected? Or worse? If things aren't going well, try to figure out why. Is there something wrong with the strategy you used? Did you pick the wrong company? Number 5. Diversify. If you don't already own investments, consider starting small by buying shares in index funds. Index funds track the market as a whole, so they tend to perform well regardless of where the economy is headed. Number 6. Review your plans. Once you have decided on your investment plans, review them regularly. Make sure that you stick to your original goals. Don't change your mind halfway through. Number 7. Keep up with technology. Technology has made investing easier than ever before. Many people use apps like Robinhood to invest automatically without having to do anything themselves. Number 8. Avoid scams. Be careful when investing. There are many scams out there, including Ponzi schemes. These schemes promise high rates of return, but the investors never get paid back. Instead, the operators pocket all the money. Number 9. Check out mutual funds. Mutual funds are pools of money from multiple investors. They allow you to pool your money together and buy stocks or bonds. The fund manager decides which companies to invest in. Number 10. Be cautious. Don't let emotions cloud your judgment. Investing should be based on facts, not feelings. Please don't wait to ask in your comments section if you have any other queries. Thanks for watching. See you in the next video. Please like and share the video, subscribe to this channel, and click the bell icon for more updates.